It's a battle of the bulls and bears. Hello, I'm Michael Smith, and welcome to the Lowdown. Well, I can't believe we're midway through the battle between the bulls and bears. It's never been stronger. I think some of the main takeaways right now is there are a lot of push and pull factors. So let me show you what I mean by that. Nearly 90% of stocks in the S&P 500 are now above their 50-day moving average. Is this a sign that the rally's overblown, or is it a sign that we're finding a new floor? It's extremely rare to go back down and make new lows when you have this much breadth. And what I mean by breadth, you have many participants in this rally. Many of them are now approaching their 200-day moving average and above their 50-day moving average. Q2 earnings continue to be mixed to positive and contingent on individual company management. Let me give you an example. Target saw its profit plunge in Q2 by 90%, but Walmart reported the opposite in the same sector. So this is basically poor versus good inventory management in times of inflation. So with respect to the market rally, the easy part of the rally is over, and we're going to have a lot of chop and flop over the next 6 months before we make a new high, rather than a new low, in my opinion. We have some economic data that came in since our last episode. Let's go through that. The CPI figure in August came in at 0. So basically looking at month over month. If you look at the producer price index, the PPI, that came in lower than expected in terms of last month. One of the big things is, and you've heard us talk about it, is when the yield curve has been steeply inverted. That means if you look at the 2-year treasury versus the 10-year, so basically short-dated treasuries versus long-dated. And when you're getting more money on a short-dated treasury versus a long-dated, that's an inverted yield curve. This is one of the best predictors of recession that we've seen in the past. And we know recently we've gotten 2 quarters now of declining GDP. So let's talk a minute about job creation. The U.S. created 528,000 jobs in July, which means basically in terms of the Fed, that could be more tightening, but also into a strong economy. Now remember, unemployment's a lagging indicator. Now, what about forward-looking indicators? Let's take a look at this chart. This chart is of U.S. job openings. So you can see here, we just saw the largest 3-month decline in job openings in the history of the data. That's excluding the initial shock of the pandemic. What this tells you is that employers are probably looking in reductions of hiring going forward. That is not good if you're going to continue to have a strong economy. So let's look at another data point, housing. Housing is one of the biggest drivers of consumer sentiment, consumer behavior. This is most likely our biggest asset that we have. So when housing prices are going up, the wealth effect, it helps us go in and want to spend more. People are more likely to take out credit cards, are more likely to travel, take vacations, eat out, do things with family. When their housing prices are declining, psychologically, this pauses consumer and consumer behavior change. So if you look here recently at housing, total mortgage demand has hit a 22-year low. Now we know that interest rates have been increasing. That is lower than 2008. So people have been asking me the question, do I see home prices declining? So let's take a look at this chart. The 2-month change in the median price of new single-family home has cratered, negative 11.9%, the worst in history, even beyond the housing crash and the global financial crisis. Now, I don't know about you, that is a bad number. Take a look at this. 7.5% of U.S. homes for sale have cut their asking price over the last 4 weeks. That is the highest we've seen since Redfin started tracking the data since 2015. Again, this is not good for home prices. So this is a chart here of the ECRI's weekly leading index, and it has actually fallen. So again, going back to the battle of bulls and bears, leading indicators are starting to fall. Well, if you think about where we were mid-year, we had some of the lowest sentiment readings from the investor surveys since the global financial crisis. So let me kind of put that in layman's terms. This is what led to low sentiment readings. We had high inflation, which caused rate hike expectations by the Fed. We saw the dollar strengthening, which basically swung as a wrecking ball across all risk assets. Now let's talk about the Fed for a moment. Yesterday's FOMC minutes stated clearly that the economic risks are now to the downside. That's indicated by the leading indicators we just went through. The Fed seems to be getting cold feet and is beginning to worry about over-tightening when inflation is still at 8.5%. Now remember, 8.5% inflation is not their target. They want to get to 2%. This means they're very likely to continue to raise rates, at least in the near term. So here's the $50,000 question. What do you do now? One, if you've de-risked, probably not a bad time to add some risk back on in accordance with your financial plan. If you happen to have cash, probably not a bad time to strategically put things to work. My recommendation would be to dollar cost average. I think now to the end of the year is going to be very choppy, not a bad time to put money to work. If you need any help, have any questions on this, please feel free to give me a call, get by our website, or send me an email. Thank you for listening to The Lowdown. Please like and subscribe. We'll see you next time.